Hi, it's Dr. Branson again. Welcome to our third video, another example of how to use expected value. So as promised in the last video, this is going to be a little bit more business oriented, a little bit more real world oriented, and is going to explain to you how this concept gets used in the business world. And one of the main ways that that happens is in terms of what insurance companies call risk. Okay? So for those of you who, hopefully, most of you are at least somewhat familiar with this idea, but you should know that when you buy insurance, so for example, like automobile insurance, your insurance company charges you a premium. So the premium is the amount of money that you pay for your insurance each year or each 6 months, something. It's always over a different time frame, but we're going to say each year for simplicity in this case. And the way that they determine how much they charge you is based on the risk of them having to pay out. Okay? So what they want to do is they want to make sure that they make enough money so that if you do have a car accident, for example, the amount of money that they have to pay you for that accident based on the terms of your insurance is less than the amount of money that they bring in, right? That's their business model. That's how they make sure that they're making money. Okay? So we're going to do a very simple very simple example of this just to illustrate this concept and to help you kind of understand why insurance premiums are different for different people. Okay? So, for example, you probably pay more for auto insurance on your car than your parents would, assuming that you have a car. And that's because younger people are more likely to have accidents. Okay? And so that's actually what we're going to look at in this problem. Okay? So, let me give you the problem, the kind of setup, and then I'll explain to you kind of how this translates into terms of expected value, so you can see how the language makes sense with what we've already talked about. Okay? So, what we have here, 43% of first year drivers are involved in an accident. And that's actually a real figure. 43% of first-year drivers have an accident during their first year driving. I don't remember where I got that from, but that is actually true. Okay? And so this is why insurance companies charge you so much for insurance whenever you first start driving, is because of this figure. You haven't been driving for long, you're not as good at it, and so you're more likely to have an accident. Okay? So that part's real. I'm going to give you some simple numbers now that are less real that we can work with for our problem. Okay? So, what we're going to say is an insurance company charges $500 a year. And for those of you who pay your own insurance or know what your parents pay, this is actually low. It's usually more than this. So $500 a year. The average amount they pay out per accident is $1,000. Okay, so very simple numbers. So 43% of first-year drivers are involved in an accident. Insurance company charges $500 a year, and the average amount they pay out in an accident is $1,000. So what I'm going to ask is, how much does the insurance company expect to make on average per driver? Okay? And so you might look at this and say, well, if you're only paying $500 a year, right, and the average payout for an accident is $1,000, why would they expect to make anything, right? But not every driver is having an accident. Only 43% of them do. And so we need to kind of weight this by the probability of you having an accident, which is where expected value comes in, right? So we can think about this in terms of expected value as there being, just like we did before, two events, right? Either you have an accident or don't have an accident, right? Either you have an accident or you don't have an accident. The probabilities are given to us. So the probability that we have an accident is given to us. That's 43%. So 0.43, right? That's the probability that you do have an accident. How would we get the probability that you don't have an accident? Well, if you do have an accident, it's 43%. If you don't have an accident, it's going to be 1 minus that. So 1 minus 0.43, which is 57%. Okay? Right? Complements again. This is has an accident is 43%, so there's a 57% chance you don't have an accident. Okay? Now we need to think about reward, right? So for the insurance company, selling you insurance is like a game, like we were playing. There's a 43% chance that you have an accident, okay? If you have an accident, well, what does the insurance company make off of you? Well, they took $500 from you, but if you had an accident, they had to pay $1,000 off, right? So they got $500 from you, but they lost $1,000. So their reward for selling you insurance, if you have an accident, is negative $500. But their reward for selling you insurance if you don't have an accident is $500. They took in $500, but they didn't have to pay you anything, right? And so they make the entire $500. Okay? So we can think about this now in terms of them having a reward for you not having an accident, right? So it's just like the game we played earlier, except the game now is, rather than drawing a marble out of a bag, the game is whether this first-year driver has an accident or not and how much you have to pay off. It determines the reward. Okay? So how much can the insurance company expect to make? This is the expected value, right? If you think about it, on average, how much do they expect to win in this game? Well, it's going to be the expected value, which is 0.43 times negative 500 plus 0.57 times positive 500. So the probability of the first event times the reward plus the probability of the second event times the reward. And we multiply them out, we add them up, and I have this in my notes. The answer is $70. Okay? So what this means is that if you charged this $500 for premiums, and there's a 43% chance that you have to pay out $1,000 for an accident, on average, you're going to gain $70 per policy that you sell. Okay? Now, insurance companies are very particular about calculating these probabilities. They calculate it based on lots of things, and then that's how they determine what they're going to charge you for insurance premiums. So they probably would want to make more than $70 because, of course, they've got to pay all of their people in the company, and they want to make money off of it. But in this case, they would make $70 per policy that they sold. Now, if you think about this, if an insurance company sells 1,000 car insurance policies, right, which is small for an insurance company like this, they'd make $70,000, right? And so this adds up very, very quickly when you sell a lot of different policies. Okay? So that's an example of how expected value can be used in the real world. And this is not just insurance. There are plenty of different other cases like this. When people are doing stock markets, buying and selling stocks, they're looking at the probability that a stock goes up or down and thinking about the expected value. So there's a lot of measurements like that here in finance. Similarly, there are medical applications. People look at the probability that you get a particular condition, and that's how they rate medical insurance and things like that. Okay? So that's the last lecture on expected value. Your instructor will also be providing you with support and helping you learn about this topic, so feel free to reach out to them with questions. And thank you for watching. And I'll see you next when we talk about our next section, which is at the beginning of statistics and talking about what statistics are and experimental design.